Silver broke below $70 per ounce this week for the first time since late March, with several market data sources showing prices in the high $60s during Friday's session, down more than 7% for the week. One strong jobs report materially shifted rate expectations in a single session. Here are the top 5 things you must know about silver's drop below $70 today.
Look at the board here today. The tape is cutting a little bit of the opposite way. Silver down around 7%, taking a hit here. Gold on the spot side down about 3%, struggling to keep above $4,500 this week. And it follows a U.S. jobs report strong enough to shift the market from debating rate cuts to pricing in a...
Silver started this week near $75, 53 cents per ounce on Monday morning, according to Fortune. By Friday, multiple market data sources showed silver trading in the high $60s, a loss of roughly $6 to $7 per ounce in 5 trading days. To put the week in context, silver is still approximately 90% higher than it was a year ago, according to Trading Economics. But it has now fallen significantly from its earlier 2026 highs. This video is not about predicting what silver does next. It is about understanding why this week happened and what markets are watching going forward. Thing 1. Silver had one of its sharpest weekly drops of 2026. According to Trading Economics, silver prices fell below $70 per ounce on Friday, reaching their lowest level since late March and heading for a weekly decline of over 7%. To be specific about the intraday move, silver futures opened near $74.18 on Friday morning, according to Yahoo Finance. By 9:36 a.m. Eastern Time, the price had already dropped to $71.21. It continued lower throughout the session, with multiple sources reporting silver in the high $60s by the close. The gold-silver ratio, which compares the price of gold to the price of silver, moved to reflect silver's steeper decline relative to gold, according to USAGOL. That comparison is something we will come back to in a moment. The short version for now. This week's move was one of the biggest weekly percentage declines for silver in 2026 so far. Thing 2. A strong jobs report changed rate expectations. The main reported trigger for Friday's sell-off was the May non-farm payrolls report. According to Trading Economics, the data showed the U.S. economy added 172,000 jobs in May. The forecast had been approximately 85,000. The unemployment rate held steady at 4.3%, and annual wage growth came in at 3.4%. Matching expectations. The jobs number was roughly double what analysts had expected.
Bureau of Labor Statistics. And if we take a look at this data here, you could see this is the employment situation for May 2026, and the total non-farm payroll employment increased by 172,000 jobs in May. Now, this number was only projected to come in at about 85,000 jobs, so it beat out expectations. And what this means is that the Fed can actually raise rates because the economy...
Markets appeared to react quickly to that data. According to Trading Economics, markets moved to pricing in a quarter-point rate increase by year-end. According to goldsilver.com, market-implied rate hike odds moved higher following the report, and the 10-year Treasury yield moved to 4.54%. The connection to silver is through what analysts call the opportunity cost mechanism.
Driving the weakness and the selling in the start of this final. It's related to interest rates, higher nominal interest rates, but also...
When interest rates are expected to rise, the relative appeal of assets that pay no interest, like silver, can decrease because investors can earn more from interest-bearing alternatives. That shift in expectations, triggered by one jobs number, was enough to send silver down sharply in a single session. Thing 3. Silver dropped more than twice as much as gold. Here is why. Gold also fell this week. Silver fell more than 7% for the week. Gold fell approximately 3%. Silver's decline was roughly double gold's in percentage terms.
On both gold and silver. You could see here the US dollar index exploding higher this morning, right when all of that data was released. And when it comes to the volatility of precious metals, silver is much more volatile, which is why
One factor analysts cite for why silver often reacts more sharply than gold in rate-driven moves is its dual nature. According to Fortune, silver's price swings are more pronounced than gold's because of its industrial applications, whereas gold is almost exclusively a safe haven asset. Goldsilver.com describes it this way. Silver runs on 2 engines. One is its role as a precious metal, similar to gold, driven by market fear, currency pressure, and safe haven demand. The other is its role as an industrial commodity, driven by demand from manufacturing, electronics, solar energy, and other sectors. When a rate-driven sell-off hits, it applies pressure to the precious metal engine because higher rates reduce the relative appeal of non-yielding assets. The industrial engine does not disappear. Factories still need silver, but it is not strong enough in the short term to offset that selling pressure. This structural difference is one reason silver can fall harder than gold when rate expectations move sharply in one direction. Thing 4, the supply deficit paradox. This is one of the most interesting tensions in the silver market right now. According to the Silver Institute's World Silver Survey 2026, the global silver market is entering its 6th consecutive year of a supply deficit. A supply deficit generally means reported demand exceeds reported supply for the measured period. The projected shortfall for 2026 is 46.3 million ounces, wider than the 40.3 million ounce deficit recorded in 2025. Yet prices fell more than 7% this week. Some analysis from Crux Investor and goldsilver.com suggests that precious metals markets operate on 2 levels simultaneously: the physical market, where actual metal changes hands, and the paper market, where futures contracts and financial instruments set the short-term price. Goldsilver.com's framing is worth noting here. The World Silver Survey 2026 deficit of 46.3 million ounces is unchanged. One Friday's data moves prices. It does not move ounces. It is also worth noting that silver demand from photovoltaic, or solar panel, producers is forecast to fall by approximately 19% in 2026, according to PV Magazine. However, other industrial applications continue to grow, though they have not yet offset the shift in solar demand volumes. What is still unclear is how quickly physical demand will absorb the selling pressure from this week's paper market move. Thing 5. The June FOMC meeting is the next major event markets are watching. The Federal Reserve's next policy meeting is scheduled for June 16th and 17, 2026. This is the next major event that markets are focused on for precious metals. Treasury yields reflect current market expectations. According to Crux Investor and Indexbox, the 10-year Treasury yield is hovering near 4.6%, and the 30-year is above 5.1%. These elevated yield levels reflect how significantly rate expectations have shifted in recent weeks. If the FOMC signals a rate hike is possible, rate expectations may remain a key focus for silver. If the Fed holds rates steady and signals caution, some of this week's rate pressure may ease. What is still unclear is what the Fed will signal. Markets are currently pricing in a meaningful probability of a rate increase by year-end, according to CME FedWatch data and goldsilver.com. But the meeting has not happened yet, and no outcome is confirmed. The Silver Institute projects a 20% rise in physical silver investment in 2026 to 227 million ounces, the highest level since 2022. Physical demand is one factor analysts are watching in the broader silver market balance, though the timing and strength of that influence is not guaranteed. It is too early to say how this will evolve. Final takeaway. Silver dropped below $70 this week because one strong jobs report materially shifted rate expectations, applying significant selling pressure to a metal that is more sensitive to rate moves than gold. The supply deficit has not changed. The industrial demand picture has shifted. Solar is declining, but other sectors are growing. And the next major event is the FOMC meeting on June 16th and 17th. This week's move is a rate expectation-driven pullback in a metal that remains in a structural supply deficit for the 6th consecutive year. Neither a confirmed bottom nor a confirmed trend reversal. A market repricing based on new macro data. Which of these factors do markets appear to be weighing most right now? Rate expectations, the supply deficit, or industrial demand shifts? Leave your answer below.